The intersection of government, finance, and emerging technology is no longer a distant horizon. It is here. It is now. Welcome to the Emerging GovTech Livestream series, presented by Blockchain Exomedia in partnership with the Government Blockchain Association. Today's episode, Banking and Stablecoins, how digital assets are reshaping monetary policy, public finance, and the future of sovereign currency. Joining us today, industry leaders, policy architects, and blockchain pioneers who are building the infrastructure of tomorrow's financial system. This is episode 3.
Welcome, good afternoon, everyone, and welcome to the GBA Emerging GovTech Livestream series. I'm your host, Felisha Stevenson, founder of Blockchain Exomedia. We are live today on YouTube, LinkedIn, and X. So wherever you are watching from, welcome to the conversation. This series exists because there are decisions being made right now in boardrooms, in Congress, and in central banks that will reshape how governments operate, how citizens access financial services, and how institutions settle value. And we believe those conversations should happen in public with the right people at the table. Today is episode 3, and we are going deep on a topic that is moving fast: banking and stable coins, the future of finance. We're going to talk about why legacy settlement systems create systemic risk, what the Genius Act means for stablecoins, governance, and what the realistic timeline looks like for institutional adoption of distributed ledger technology. Before we get into it, let me bring in our panelists, because the people in this room today are exactly who you want to hear from on this subject. Panelists, first is the founder and executive director of the Government Blockchain Association, the leading nonprofit dedicated to promoting the understanding and adoption of blockchain technology in the public sector. GBA has over 175 member organization across the government, industry, and academia. And this series would not exist without his vision and partnership. Please welcome Gerard Dache.
Hi, Felisha. Great to be here today.
Wonderful. And it seems I am having some audio difficulties here, but I'm sure Gerard would be more than happy to step in for me here.
Sure. Can you hear me, Felisha?
Let's see here, because I cannot hear anyone.
Test 1, 2, 3. Can you hear me, Felisha?
Next, he brings over 30 years of experience in financial services, having held senior positions at 2 of the most recognized institutions in the world, Morgan Stanley and JP Morgan Chase. He is now the co-founder and head of design at L4S Corp, where he is working to bridge the gap between traditional finance and the emerging digital asset ecosystem. Please welcome Paul Dowding.
Hey, Felisha. Thank you for having me.
Hi, Paul.
And finally, he is the CEO and co-founder of Black Wallet Limited, a company at the intersection of blockchain infrastructure and real-world financial access. He brings a practitioner's perspective to everything we're going to discuss today. Please welcome Chris Smith-Meyer.
Chris, so close. Felisha, thank you for having me. I think I got it.
Thank you for being here. We have a lot of ground to cover, and I know your audience, for our audience, came ready. Let's start at the foundation. Gerard, for anyone who is just joining this series for the first time, can you set the stage for us? Why does blockchain matter to government right now? And why is the banking conversation the one we need to be having in the 2026?
Sure. Well, I was just having a conversation with Paul and Chris right before we came on air, and sharing that I just watched Margin Call, right? And then I've seen the Big Short, and there's a bunch of other movies about that from the 2008 financial crisis. and the question that I had for Paul and for Chris is, guys, hey, in the movie there were some warning calls. There were some people that were seeing the handwriting on the wall, and they were starting to sort of sound the bells and the alarms that there's about to be a major shift in the finance world, right? And then I said, hey, is that happening now? Are we looking forward into the future, and are we seeing that potentially there's going to be some major disruptions? And in talking to Paul and Chris, they're like, absolutely. So that's what we're going to talk about today. Is there are a lot of things, big things that are going to change, that really are going to rock the world financially, and it's just important for people to be prepared for those things. And I think we lost Felisha. So listen, let's Paul, why don't we'll carry on. You want to just kind of share some of the opening thoughts that you have, and then Chris, why don't you do the same thing, and then we'll get into some of the questions.
Yeah. Well, again, it's an interesting time where you've got the crypto DeFi world demonstrating success and use of new technology and innovation, and then you have the traditional finance world looking at this new technology and saying how what is the benefit to us and how can we implement it. So you've got one side, the TradFi, sort of jealously looking at the innovation and technology and trying to apply it. And you've got the crypto DeFi world jealously looking at the hundreds of trillions of assets that traditional finance has and saying, how can we take it over? But there's a lot of interesting points between the two worlds on, how this can be achieved and why people perceive there are benefits, but yet there's still some hurdles to overcome, in many different ways, operationally, technologically, as well as from the regulatory side.
Chris, and you want to start out with any sort of opening thoughts? We had a little bit of conversation about this prior, but you want to just kind of set the stage for us a little bit?
Chris is a spinning wheel.
All right. Well, Paul, I tell you what, you and I will have to carry the show, which is fine.
Okay. Let's go through.
Yeah. Right. Okay. So, Paul, one of the things I've heard you talk about a lot, right, is the whole TradFi world, right, and the DeFi world, and it's not one or the other, but how they have to come together. Would you mind just kind of sharing those thoughts, because it's I think it's an incredible perspective.
Sure. It's interesting what you were saying about what was the financial crisis, which is in our near-term memories, although it was really 13, 14 years ago. Really, when you look at the series of financial crises, even if you go back to savings and loan, bearings, long-term capital management, the real thing is that it's about assets versus liabilities. If you're looking at your balance sheet, you've got assets on one side and liabilities in the other, and if your liabilities exceed your assets, things can blow up. And the problem is that sometimes if you've got too much leverage, and the difference in duration, meaning in the financial crisis you mentioned, you had 10-year mortgages backed by 90-day commercial paper. So when the confidence was lost in the commercial paper, there was nothing to finance the mortgages, which created a whole sell cycle. And so you've got a need to understand your accounting and the risk management associated with it. So that's the trick in terms of managing risk. But when you're looking at DeFi and crypto, it's, with the benefits of what is a blockchain or distributed ledger technology, is that it's 24/7. Normally you're operating in markets that have an open and a close. It's virtually real time, very quick settlements of transactions. So, we agree to transact, we transact, and we settle very quickly. And really, more importantly, the blockchains don't care what you're transacting. You can tokenize anything. So it's asset agnostic, whereas in the financial industry, depending on what product you're buying, it's an equity, a government bond, futures, and an option. They're all on different infrastructures. So in blockchain language, the banks and brokers sort of act as a layer 2 to talk to all these infrastructures. And whereas a blockchain is everything, in terms of it will take anything that you can tokenize. So and the real-time settlement has, again, outside of risk, because most trades settle now T+1, although foreign exchange is still 2 spot 2 days, you've got an exposure, a settlement risk. And when you look at the NSCC, the National Securities Clearing Course in the US, while there can be trillions of dollars in transaction value, the big brokers tend to buy and sell, and it nets down, but it still nets down to tens of billions of dollars of exposure for one day. And the brokers actually have to post collateral to manage that, $50 or $60 billion exposure. And it's usually in the range of $10 to $12 billion a day. And that's because we're all settling the next day. So if you could bring that to intraday, that's $10 to $12 billion that goes back to the balance sheet of the brokers, which then reduces the cost of executions, which then passes on to the fund managers or the investors. And you've got that sort of low risk. So there's a lot of reasons why the infrastructure wants to change. The question is, how can it? And one of the problems with the centralized settlement is that it requires, when the markets used to be all sorts of different settlements, T+7, T+5, there are different things around the world, but they all consolidated down to T+3. And then they went to T+2 and moved to T+1. There are some T0 markets, but they're rarer. But the point is that they had to do it as a big bang, all at once, everybody together. And going from a shorter period with a couple of days or one day to work out what's going to happen the next day is manageable. Once you go to intraday, you now need intraday netting and financing, or understanding what's happening. So that's a logistic that exists in the market, that the current market infrastructure cannot just go to T0, same day intraday settlement. The infrastructure just can't handle it, and to try and do it as a big bang would be almost impossible. So therefore, the attractiveness of distributed ledger and blockchain is that it offers that opportunity not only to bridge to an intraday market, but also to be phased in. That's the other thing that a blockchain can do, so that you can phase it in rather than doing a big bang. Having said that, one of the key things is that when you execute a trade, how do you pay for it? And then how do you know you've got the assets to actually sell? And in the crypto DeFi world, they work on what we call long positions. They're pre-funded crypto assets versus other pre-funded crypto assets. So you've got them available to settle immediately. But in the real world, in traditional finance, if you go to buy something from your brokerage account, I hate to say it to you, but you don't have the money. Well, you do, but it's in a money market fund. So you have to redeem it to get the money to buy your security. The broker that's selling it to you or executing your trade in the market is going to buy, borrow, or get it back from loan. So there's this idea of pending or contingent, payable receivables, obligations. And the big brokers, like I said, they net down their exposure. They have buys and sells with each other, but they don't settle each one individually. They net them down. Now, that's easy to do on a next day basis. But on an intraday basis, you need to be able to sort of say, how long am I going to have this exposure? Is it 5 minutes, 5 seconds, or 5 hours? But you can agree that with your counterparty. But the point is that you need to net the transactions. And right now, the crypto DeFi world doesn't have that capability of doing payables and receivables. So therefore, how do you create a netting and financing and sourcing capability within blockchains is one of the things we've worked on. But that's, I'm just explaining right now, you've got this capabilities on crypto DeFi, and you've got this volume and, functionality that's required in TradFi. And the answer is not one taking over the other. I think the real answer is to take the best of both and combine them. And the last point I'll make, without being able to record future dated obligations, what you talked about in the big short financial crisis was if you've got no measure of risk, you can have things like or unchecked managements of risk. Long-term capital management had huge exposures to different prime brokers and different legs. The financial crisis was off-balance sheet mortgage, special investment vehicles, so that we're highly leveraged and out of sync with each other. That was the challenge that ended up now in crypto DeFi world. You can go in and get risk from a protocol or leverage, but you have no idea of how leveraged everybody is because you can keep on re-leveraging, and there's no single counterparty. So there might be a distribution amongst the market, but technically you could have an overexposure there, and no one would know about it until it's too late. So there's some, that's what I'm saying. There's some balance of what's out there between crypto DeFi and TradFi, and it's not a simple case of take the technology for one and apply it to the other, or take the practices from TradFi and apply it to crypto DeFi. You really have to think about the merger. Sorry, I covered a lot there, but
yeah. Well, that wraps up the show. Thanks, everybody.
So I was going to say, although Felisha mentioned, I did work at Morgan Stanley, Chase Manhattan Bank, who's now JP Morgan. I've also worked at Goldman Sachs and Bank of America and BNY Mellon, and also consulted with some of the large hedge funds. And through various circumstances, some of my choice and some of not, I've ended up working within the infrastructure of banks, brokers, fund managers, and clearing houses. And that's what led me to this industry, because there is a huge potential for this distributed ledger technology for TradFi, but it's how you go about it is the challenge.
Hey, Paul, how can people, you covered a lot, and I'm sure people might have questions. If they want to reach you, can they reach you on LinkedIn? How are some ways that people can, we're going to continue going, but why don't you throw that in there real quick?
No, I go under Paul Left Outing on LinkedIn. That makes it easier to find me. You can see, reach me there, or you can see my articles I posted on LinkedIn. And I also have a YouTube channel where if I recorded videos that they're all captured there. It's called The Blockheads Thoughts Distributed. If you can find that on YouTube, that's where you can also get other information.
Awesome. Chris, how's your audio doing? Let's see. We had lost Chris for a little bit. Hopefully you're back.
I think it's working.
It's working.
Can you hear me?
Yeah, perfect. Can you hear us?
Hey,
Chris, we need you to disagree with everything I just said.
For those of you who don't know, we've been friends for a long time.
I have to agree with you.
Remember that brown paper bag I gave you earlier. Then you're going to agree with everything.
So Chris, listen. One of the things that Paul just outlined really, really well was the big differences between traditional finance and all sort of the infrastructure and the risk, because things are not always on the surface, right? In the DeFi space, it's all pretty much right out there. And you and I were having a conversation before you came on about the banks and the central banks not having to follow the same rules that they're expecting these crypto, these stablecoins to do. So you want to just kind of give us some opening thoughts in terms of kind of this clash between TradFi and DeFi, and just kind of where we are right now.
Well, I think the battle between TradFi and DeFi has been really interesting, because at the beginning, it started out with the big banks saying, "Oh, crypto is not a real thing," and then we found out that while they were saying crypto is not a real thing, they were building their own products in the background in the DeFi space that were crypto products. So it's kind of a do as I say, but not as I do. And then last summer, they passed the Genius Act, which has been a disaster for the industry, because a lot of the stables outside of Circle and Tether have moved offshores, and none of the bank stables that have come out so far have been even remotely successful. And it's really interesting because now the American Bankers Association has got heavily involved with the Clarity Act, which is the new law that's coming out this year. And one of the magnifying glasses that come out whenever you start lobbying very heavily in another industry is people say, are you following your own rules? And as we've seen with some of the revelations that have come out from a few of the big banks and some of the negotiations of the Clarity Act, a lot of the banks aren't following the rules they want crypto to follow. As you guys all know, the fractal reserve requirement in the United States right now is 0. So if you go to your bank and want $10,000 out, they don't have to give it to you. Now it's bad customer service if they don't, but they're not required to have that on site. With crypto, they want it to be either fully collateralized or over collateralized, which is a very broad and stark disturbance. And the big question that it's bringing to light is, what is the measure of value? Because as the world steps away from the petrodollar and starts to grasp for new values, whether they're trying to have the brick or whether they're trying to go after the Emirates or whether they're trying to return to the dollar, they're starting to realize that the central bank fiat currencies really, their only backing is violence. If you don't pay your taxes, if we say we want more dollars and you don't pay more taxes, we arrest you. And they're doing the same thing in every country. This is not just an American thing. This is in every country. You have an unbacked system that doesn't have a value basis. And whenever the whole world was just saying, okay, a dollar is worth a dollar, the economic system worked. But now we're seeing massive fluctuations. We saw the INR take a 50% hit about 6 weeks ago. We saw the US dollar take a much slower bleed since last September. We've seen the ruble and several other currencies take major hits. And now we're looking at the Chinese property markets, and they're saying that a lot of people own buildings that don't exist. And as we go through the system, the TradFi system, and this is coming back to Gerard's point, is that there was no clarity. Like, there were these regulatory audits that everybody was going through, and everybody was saying, okay, well, you're validating my books off of Chase's books and Chase Bank validating their books off Bank of America books. And there was no standard. There was no guardian star that was saying, this is what the real facts are. And now we're seeing the effects of that. And that has been what's driven the boom from the mortgage foreclosure crisis, where we didn't learn our lesson from that whenever banks were giving mortgages on houses that didn't exist. Now they're giving loans on products that don't exist. Now they're giving loans, once again, on houses that don't exist. And this is what blockchain brings. And right now, everybody's grabbing for as much money as they can, because once we make this transition, once we move on to products like Kiros or Tapestry X, where there is a verifiable ledger where you have to have proof before you can make a transaction, these cash grabs are going to go away. The fraudsters are going to slowly fall off, and we're going to have a financial system that's actually viable. And I'm glad that Paul's out there on the front lines with me fighting for this, because this is the future we deserve, where people aren't just a number based on their debt. They're based on what they're contributing to society. And I think that'll lead to a lot better society, because right now it's just how much you owe other people.
So listen, let me ask you.
I completely disagree with you, Paul.
No, that's all right. It's a different perspective. I was talking about the uncharted risk, and you just told them why.
Let me ask a question and turn it over to Felisha, and maybe she can then ask a little bit about some of the standards and things that we can do to baseline assurance. But it seems like there's two problems or challenges, right? One is systemic, right, which is kind of the 2001 financial crisis thing, right? And then the other one is, can we trust the data that's in the systems and the solutions, right? So we've talked a little bit about the systemic risk, but I just want to cover one more thing with that, and you guys can maybe just give me a quick answer, and then Felisha, why don't you then maybe you can ask about sort of standards and stuff like that. How do we brand assurance?
Right.
Are we facing a point where people will start taking money from fiat currency, putting into crypto, putting into stable coins, and all of the games that people can play with the traditional system, right? Which is, like you guys are saying, they don't have to follow the rules. It's risk based, right? It's they can package derivatives and put it with, and hide assets and kind of hope that everybody doesn't pull their money out at the same time. Are we on the verge of something like that, or is this sort of systemic challenge one that will sort of work its way out? So Chris, let me throw it over to you first, and then Paul, and then Felisha. Then maybe we can talk a little bit about the product assurance stuff. Chris?
I think we are coming to an inflection point on this because there has to be a change. Another note on things that exist or that have been sold that don't exist. They say that the reserve banks of the world hold about 250% of the gold that they actually hold. Like they have more gold on paper than there is actually in existence. And that has to change, because even though we're not still on a gold standard, I mean, it's still one of the backbones of the world economy. And people think that they have these notes that say they have a bunch of gold. The Saudis are probably the worst because they have probably about 5 times as much gold on paper as they do in reality. And it becomes very dangerous, and we need this sort of digital proof. And as we've been moving away from paper ledgers where people can keep 2 sets of books to a digital ledger where everybody's looking at the same book, I think you're right. I think we are coming to a point where the change has to be made. It's no longer an option, it is an eventuality. And it's just how long the people that are cheating people can keep it away from happening.
Paul?
Yeah, I think when you look at, although there's some security and consistency to central clearing, each of the participants are on their own ledgers, as Chris is saying. So how are they accounting for that? And then there's a lot of bilateral clearing, individual to individual or business to business. So there's a lack of consistency. And I think what the real long-term potential of blockchain or distributed ledger is to actually add that universality and consistency of a certain level of accuracy. But because you're consistent, you're now driven by the same set of reporting and interfaces. So therefore, it's hard to, you're not interpreting it in your way, you're being fed it in a consistent way. And that universality is such a sort of powerful thing. And if I really want to get ahead of my skis when it comes to distributed ledger technology or networked accounting ledger technology, as we call it in Tapestry X, the internet protocol, think about it. You had to dial up to a phone company to get a connection to talk to somebody. If you were doing a video conference call, it was a logistical nightmare, getting the connection, drive it, and do everything else. If you had an email, you could send it in your company, but not outside. Why? Because every email system was different. What the internet protocol said was, if we have a consistent protocol, I can consistently send packets of data between and through a network of networks between where does the person begin and where does it go to. And even everybody that's participating in this video call, what did you do? You clicked on a link and said, I want to participate. I want to receive data from this source. The data happens to be video and sound, but it could be any form of communication. So that's what the internet protocol did. Now imagine a transaction protocol where you basically say, I want to transact with you, and it doesn't matter where you are. I start here, you start there, and we can transact. So that universality makes it obviously a lot more simple and efficient, but the consistency is what's key, because then it becomes easier to guide compliance and also measure risk and consistently report. That's a long way off in the long term for everyone to get consistency, but I think the driving force is going to be the benefits of what can be done in terms of efficiency, lower cost, and like I said, universality and access, which we can talk about. But that's what I think that's the motivator. I mean, that's what the internet did. It said, look, communication is easy. Boom, and no one could imagine Airbnb or Uber or social media before the internet. The idea of all those computers being able to talk to each other, people were like thinking, well, there's going to be this massive exchange trying to sort out all the communication links rather than this disparate network of networks and a very simple protocol.
Okay, and then with the Genius Act and everything that's evolving with the regulation, what does the assurance actually look like for the stablecoin?
So there's still a lot to be in the Genius Act. It was focused on stablecoins. So it's very sort of clear in terms of, how you had to be an issuer and what your assets had to be. Ironically, it didn't talk too much. I think it mentioned blockchain 3 times in the whole act. It more or less said, buyer beware and the issuer is liable, so that there wasn't clarity. Now, there was other things to be defined in the act, and I think the Clarity Act is also going to add more stuff to be defined. But right now, I think what I don't like is the regulators chasing the latest shiny object. And with stablecoins, there's a lot of money being made. Who can argue with Tether if they're making $93 million per employee a year? It's like, seems like a good business, but what is it really? And at its basic form, it's a cross-crypto exchange mechanism, and it's a cross-currency exchange mechanism. But it's not, it's a pre-funded payment solution. And again, that's a key thing. It's like having a pre-funded debit card or Venmo or Zelle as a pre-funded payment. When you've got the money there, it's easy to transfer it quickly. The real thing, and Chris was hinting at this with banks, is that banks are, leveraged businesses, and while people know central banks can print money, commercial banks can create money out of nothing. And the way they do it is very simply, it's like if you put $1,000, they can lend, let's just say $910. Well, that $910 is now deposited in another bank. Suddenly, the money supply has gone from 1,000 to 1,900. Now, what it is the banks have a liability of 1,000 to the original depositor and 900 here, but they also have a loan. So it all maps out. But what we're saying is they get this multiple leverage into it, and that's a key thing. Not a problem in the industry, but you just have to know there's that risk that exists and that leverage. And
but Paul, isn't it true that if everybody paid their debts, our money would disappear?
if you go off the US reserve, it's about 12 to 1, right? 8.5% or whatever, the reserve is. So technically, if every debt in the world was paid off, the money supply would drop to 1/12.
Well, because what you just said is, if you give me $1,000, right, and you take that out of your bank, and I deposit in my bank, right, my bank can then take $900 of that
and lend out,
right?
$1,000 can be turned into $10,000 by the commercial banks.
Yeah, and then Felisha puts it in her bank, and her bank can now lend out $800, right? And then, give it to somebody else.
It's a funny thing because we can go back to It's a Wonderful Life, where Jimmy Stewart is explaining to his, I will pay you, I'll lend at 6 and I'll pay you 3%, right? Now, in the famous scene, he's sort of saying I can't give you your money because your money's tied up in his mortgage. Now, that's a little bit of a lie, because the money was used in his mortgage. It came back into the system, didn't it? I mean, he bought the house. The person who sold him the house put the money back in the system. What he failed to say was, really what's happening is I took your deposits and I could lend it to him, who redeposited it with me, that I lent it again and redeposited it with him and leave. So I only have 10% reserve, which is why a run on the bank happens. So if a bank can turn $1,000 into a 10,000, it only has 1,000 on deposit accessible to give away. So when there's a run on the bank, it's not because the banks don't have the money, it's because they're naturally leveraged and their true assets, their assets are the reserves plus all the loans. Their liabilities are all the deposits, but the deposits are backed by loans. So if you come in and say, I want all my money, guess what? It's because that's the reality of It's a Wonderful Life. It's a leveraged life. It maybe should be turned back into, I don't know, but that's
So if you go back to 2008, right, when Satoshi Nakamoto created Bitcoin, right? And again, this was a problem in the insurance space, right? But it's not irrelevant in the banking space either, right? And so,
I was going to say the Bitcoin was a pure like long asset that you can only transfer between parties, right? In other words, I've got Bitcoin now, you have Bitcoin. So it was a purest, non-fractional reserve, non-leverageable asset. The problem is you now have crypto DeFi where you can take your Bitcoin and stake it and then leverage it and then leverage that again and leverage it. So there's actually a natural market for leverage that's occurring in crypto in the DeFi world, although Bitcoin as a pure asset, is just transferring long assets, so it doesn't increase or decrease. But by leverage, it is doing that indirectly.
Wow.
A neat difference between what the banks did and what we we do in the DeFi space is whenever you leverage the Bitcoin, you have to do a wrap token to leverage it. Yeah. And then there's a new asset created. So you can't say it's the same dollar like the banks do, where they say $1 worth of dollar. They have to move that across. So it becomes very interesting on that there is still a proper ledger, and it's like talking to Paul about ledgers is like talking to the Pope about Catholicism. I mean, Paul knows Paul has forgot more about ledgers than I've ever learned. But with this,
only from an operational perspective. I'm not an accountant.
Yeah,
I just have to make the books work. That's the back office guy.
Felisha, I think we ought to ask you. Let's bring it down to more products and services kind of thing, right? Because both of these guys have gone through a BMM assessment, so maybe we should.
Yes, that's true.
Yeah, so let's go from systemic down to more practical. Chris, why don't we start from you? You want to just talk a little bit about how and why is it important for us to trust these different solutions, and how does the blockchain maturity model play a role in that? And then Paul, I'd love to hear the same thing from you.
Well, trust is as odd as it sounds. Trust is the most important thing in a trustless system, because if you can't trust the system, then the trustless system doesn't function at all. And the BMM is a major part of like a three-legged stool. First, you have to have competent programmers making things. And as we look at the EVM library and the SVM library, the libraries are getting better because programmers are creating source code that people can then modify to do what they need to. So that leg is very, very strong. The second leg is the audits for the security, which there is still some space in there. And I believe the BMM has a standard for audits coming out pretty soon. So that's going to start to rectify as well, where there's a international standard for actual audits to make sure that the security is properly there. The part that the BMM really fills in the gap to help people trust is it looks at the business and it looks whether there's a functionality of the business. Because when we saw crypto start off, what we saw was a lot of people had a great idea, but no corporate background and no idea of how to run a company. So you saw the tail wagging the dog a lot. And that became very, very dangerous because people could go out there and they'd raise a bunch of money and then 3 months later they were gone because they didn't have the business backing it. What the BMM does is it provides a reliable standard for people to say, hey, is this company going to be here in 3 months or in 2 months or in 10 years? And that really brings the three-legged stool together because you have competent coders, you have competent security, and you have competent business. And those are the three things that you look whenever you're looking to invest, or they're also the three things you look at whenever you're looking for a company that you might want to work for a couple of years. So I think it's really important. And we were honored to get our level 3 assessment from the BMM officially at the Capitol last week.
Yeah, and you really raised a tremendous point, and that is because a lot of folks have asked us to evaluate their blockchain system, and people tend to focus in on what they know, right? So if they're technologists, they deep dive in the technology.
Right. That's true.
And they're totally ignorant about the business aspect of it or all the other elements of it. So they have built great technology that falls apart in 3 months because they don't have any usage or any, they don't understand the markets. They don't understand all that other stuff. So totally totally right on that.
Wow, level 3. That's really good.
Yes, it's the highest level that anybody's achieved yet.
Right. Yes.
Paul,
Wow.
you guys, you want to just talk a little bit about how the BMM has impacted you guys as a business?
Sure. So, I mean, I was lucky enough to be part of the group that helped co-author the BMM standard, and then ultimately helped document a supplement for banking and finance, because we found that while we had the BMM is very thorough on 11 elements, 5 levels of maturity.
Mm-hmm.
When you came to particular use cases, and Gerald's very good at explaining this, but elections have different privacy laws than records keeping in healthcare versus banking and finance and anti-money laundering. So you've got different standards or different requirements, specialized requirements, and that's what we did, with the supplements. I was reluctant to go through assessment because we did, obviously help compile it. And I thought, it looks a bit self-serving if I'm going at the early stages. But as Gerard said, when we first started doing this, we actually had to prove the process. And, I've got the scars to prove that it's very thorough. But the interesting thing, and this is why I just want to give some people some reassurance, as much as there's been problems in the financial services, there are, regulations and compliance and risk management to protect investors, to protect clients, and to protect the industry. Is it perfect? No. Can we go down a path of of craziness? Yes. Is there problems with crypto DeFi? Yes, in terms of what's there in standards and everything else. But I think what we see is, and this comes out in, if you're think about a credit card, it's a loan with payable receivables. So if you don't have the ability to do accounting and future date obligations, you cannot issue a credit card. You cannot do a simple loan. You cannot leverage a market trade. So we believe and are in the process, proving that really accounting is the universal language within the distributed ledger that can act as the bridge. And when you look at both sides, the crypto DeFi world is dipping its toe into TradFi, creating synthetic exposure. Like, you can't own IBM, but you can get to the return on it. The TradFi has got like the Bitcoin ETF. It's an ETF. It's a share issued on the New York Stock Exchange. It gives you exposure to Bitcoin. They've got the digital money market funds are a bit of a sleight of hand, but there's other places that are working on actually creating true exposure to equities in a crypto experience, meaning it's pre-funded. I think New York Stock Exchange and ICE, the Intercontinental Exchange, owns and New York Stock Exchange is working on that. Imagine that, giving a crypto DeFi experience of exposure to US equities. Now, it's not a US equity settlement solution for long-term for institutions, but it's there. But that's where the level of detail, where I think the BMM looks at different solutions and says, what really are the requirements? And a key thing I like to emphasize is it's not about who's the fastest, bestest, cheapest, whatever. It's actually saying, does your blockchain solution meet the requirements of your use case? And does it meet other general requirements, like Chris was saying about the sustainability of the infrastructure and the governance model and other things? So you've got this robust way of saying, as a solution provider, I can prove it, or as a solution buyer, I can be, happy about the conclusions, or as an investor, that this solution meets those requirements.
Yeah, I think it's a great thing for anybody who's got a blockchain solution to look at, to be able to really let their investors know, let their potential customers, let acquirers know that they can be trusted.
Yeah, and it's very much needed, because a lot of companies, some companies don't even want to go through the assessment because it would, I think some of them feel as if it would expose some things, so some companies don't feel comfortable. I don't know how much we can say, but I know that, there's certain companies that, once they understood some of the things that they may have to be transparent about, they, didn't want to kind of go through that process of the transparency, especially some that have already been caught up in, some legal situations.
Two things about that. So we do, the GBA does the assessments under NDAs, and so the details that are disclosed are purely between the client and the assessment team. The actual published is, very simple. You published at this level. The BMM standards are published, but the actual records are completely confidential. There is a final presentation with the conclusion of the team, but that's at the client's choice to share with their investors or clients. So it's not as much as it's it's a private exam with your doctor, not a public, display.
That's a good way of putting it.
Just to reassure people, that's definitely the case.
Well, to be fair though, if we, whatever we're doing an assessment, if we find anything that illegal that's going on, we are required by law to report that. And I think there's a couple companies that have kind of stuck their head in and then pulled their head out, that knew that their books were crooked. And I can think of one example where they said that they weren't going to do it because, hey, it's going to show how we handle our money. And it's like, well, that's what the investors want to know. And they took a step back from that because it is important. Now, this isn't somebody made a mistake in accounting. This was a well-known crypto scam. And I think Gerard knows which one was the one that talked to us about it. And they just wanted to basically get rid of the guilt. And this isn't that. This is a thing to show that your company is working properly, not, oh, well, we made a mistake in the past, make us feel better because we just want to pay for an audit. So this is an actual assessment that really tells people that you're doing the right thing as opposed to just covering up the past. And to Felisha's point, there are a lot of cryptocurrencies that won't do it because they can't even meet the basic levels, because if they're just a cash grab, they're not going to make it through the system.
Right.
Yeah. Hey, Chris, you got some personal experience from smart contract audits, right? So again, what all of these solutions are trying to do is they're telling their user community, right, investors, whatever, hey, you can trust us. One of the ways that they garner trust is that they say, hey, we've had a smart contract audit, right? Now, a BMM is a smart contract audit on steroids, right? But Chris, do you want to go ahead and just share a little bit about your experiences in how people have tried to buy trust, which is kind of what the person that you're talking about, they had done some things they really shouldn't have. And they were trying to they thought they could essentially buy trust by buying a BMM assessment. But you want to just share a little bit about the smart contract audits as an example of this whole issue?
Yeah. Well, whenever we started off with Kiros, like, we were very determined we were going to get a smart contract audit because we wanted to prove that we could do this. And I've talked to dozens of auditing companies, some very good ones and some very bad ones. And the one that Gerard's alluding to is there was a company in Germany that I was speaking to about a smart contract audit. They don't exist anymore. They finally got caught. But I called them and I said, hey, I'd like to get a smart contract audit. They said it'd be $500. I said, okay, where do you want me to send our code to? And he said, why would you send me your code? You send me $500. I say that your code's good. Just flat out. Like, wow. No hiding it at all. And then on the other end, you have amazing companies like Hacken and Quill that do very, very thorough audits. And Andres Ursus project, I can never remember, Providio, does a very good formal verification. And they helped with the writing of the audit standard and working with companies like that to bring the audit standard to the forefront. And the more auditing companies we talk to, like Certex, Zokyo, For Your Eyes Only, the auditors, and getting them to come in at the same standard level brings up the whole industry, because the ones that I named, those are companies that are working to make the industry better. There are a whole lot of other companies out there that aren't. Now, just because I didn't name a company does not mean that they're a bad company. There are a lot of good companies out there that I haven't talked to, but those ones that I've named, I've actually gone through and talked to them about their certification standards and what they do and how they do it. And it is there's a very large dynamic in the field. And as the audit supplement comes out, I think it will be very useful for members of the field to know who meets the base standard for having a good audit.
Yeah, and I want to throw one other thing out there, Felisha. I don't know if you and I have talked about this, but Sam Bankman-Fried and FTX, they went through they passed 3 accounting audits, right? without any findings. 3, right? And here's what I think happened. I think that when it comes to blockchain, crypto, DeFi, and the traditional finance space, in the traditional finance space, Paul, you can speak to this. There are very, very solid controls, right, that have developed over years and years. But these people come to a DeFi, crypto, blockchain thing, and I just can imagine Sam Bankman-Fried waving in hands and saying, "Oh wait, this is crypto. It's way too complicated for you to understand. Trust us, it's good."
Yeah, but the interesting thing is it had nothing to do with crypto.
Yes.
It had everything to do that they were managing their accounts through their money through a single account on a spreadsheet.
Well,
and just to give you an example of when I say you've got separate ledgers, even in TradFi, Madoff is the perfect example. Where his auditor was a man and a dog in Florida who had retired 10 years earlier, but no one bothered to check in. So again, it's not. Again, the risks that are there are risks available to crypto, DeFi, and TradFi. There's different mechanisms of the risk because of the nature of the technology or the process or controls. But again, it's like I think the point to emphasize with the audit companies Chris is doing mentioned and the BMM is you want to have validated processes to back up your assertions.
Absolutely.
From our perspective, smart contracts came out of the crypto DeFi world. We've just got very dumb in configured transactions, so we avoid that whole problem altogether. But that's a different story. But there's ways that you can control it. But the key thing is not to see any of the solutions as just it's perfect and it's got to be good for a rational reason and a provable case and there's always like I said it's a matter of the standards that are there and are they being followed.
Yeah, we probably should wrap it up pretty soon. But before we do, I do want to say 2 things. Paul, you've got the best blockchain solution for banking and financial services I've ever seen. There's a reason why it went through the assessment, why it really sort of set the standard. It's called Tapestry X. So if anybody is looking for blockchain solutions in the banking and financial services area, please check out L4S Corporation, Tapestry X. Paul leads our banking financial services working group. He's been voted and is now a board member of the GBA. So he's elevated in this area because really of what he's earned over the years. You can tell from his experience. Chris is a genius. Chris, how many books have you written? How many law degrees do you have?
I'm well over 20 books right now. I think I might be over 30 now. And I have 3 postgraduate law degrees. So then I have another 6 degrees to keep them company. So
so
someday I'll get that DISN.
Yeah, he's was one of the primary authors of the model law, the United Nations Internet Governance Forum Dynamic Coalition on Blockchain Assurance and Standardization, model law on digital assets. I forgot the full title.
And I can assure everybody that Chris didn't take 5 books and leverage them up to 30. He genuinely did.
Chris, if people want to reach out to you, how do they get a hold of you?
The best way to get in touch with me now is to just email at info@kiros.io. So info@kiros.io. And then you can also meet up with me by coming to the GBA events. I try to make it to every one of them, or somebody from my team will be there. And if you want to talk to us, grab their information. For those of you that live on Telegram and all the other socials, that's a great way to meet up with us.
And Felisha, I want to thank you for producing this event. You want to just tell people a little bit about if they're interested in your services and how they can get in touch with you?
Yes, absolutely. So blockchainxomedia.com. If you want to have your voice be heard, then you can definitely reach out to me there. I'm also a member of the GBA for half a decade, as I always say. It's a Gerard. He says that sounds forever. But yeah, so so you can reach out to me there. And everyone, thank you for this wonderful conversation. It's definitely endearing and everything that I desire for it to be. Thank you so much, Chris, Paul, and Gerard. Thank you.
Thank you, Felisha. It was great having us. Thank you.
All right.
Thank you.
Have a great day, everybody. Bye.
Everyone, enjoy your lunch. Bye-bye.
Good.